Trading a downward market is difficult, no doubt. At the same time, however, downward markets can also be very volatile, which means we don't have to risk as much on any individual trade to still generate our targeted returns. In today's market forecast, I'll share a couple tips to help you navigate this difficult trading, do some special analysis to see how far down the market might actually go before it finds support, and wrap up with trades for planes, trains, and cruise liners. As we kick things off, all eyes are on oil. To take a look at this chart yourself on Brent oil futures, you go to ticker symbol BZ1 exclamation mark, or in TradingView, it's abbreviated BZ. And here you can see that oil prices have been skyrocketing, gapping up on Monday's opening session, but then trading down overall. This is actually called a bearish engulfing pattern. It may bring some optimism to the hope that oil prices settle back down here in the very near future. While prices remain high, this is creating downward pressure on the overall market. The S&P 500, the Nasdaq, the Dow, none of it is immune to high oil prices. Now, there's a saying in trading that the solution to high commodity prices is high commodity prices. What's going to happen here is, since oil has become suddenly very profitable to produce, all North American oil companies are going to be pumping as much as they can possibly can and flooding the markets with supply. So while in the short term, yes, price is skyrocketing, I don't think it's going to be that long before we see oil prices come back down. In addition to oil, the other thing that we're watching like a hawk is the 200 daily moving average. This is the S&P 500 here, and you can see that price action is sitting right near the 200 daily simple moving average. And it's not just the S&P, it's on the Qs as well, sitting on the 200. It's on the Dow Jones Industrial Average, sitting on the 200. Let's go back to the S&P 500. Should price action begin to drop below this 200 period simple moving average, we could certainly watch it continue on down lower. Now, the question is, how far might that price action go? To illustrate that, I did quite a bit of work with our power trader students on Monday morning, and we established these two orange lines. That's called Fibonacci confluence. Now, the process to get there takes way longer than I want to spend in this market forecast, but you can think of this as laser focused, super special support down here at 642, and then a second support at 612. Now, the reason this is interesting to me is you have to come all the way on down to about 560 before we experience a 20% retracement from the S&P highs. Why is 20% an important number? Because that's the general understanding of when we would enter bear market territory. Should we get down and surpass this red line, you'll start hearing all the news reports talk about, oh, bear market turn and recession and all the things. But the good news is we've got two very potential points of support long before we get down there. Now, I'm not saying we have to stop at these orange lines. I could see a scenario where we head down even lower, and should that happen, we will develop some additional points of support below the 20% retracement. But I'm hopeful and optimistic that we will bounce here. There's a few indicators that are showing maybe we're starting to find a little bit of a bottom. Stochastic's one of my favorite oscillators. Whether it's a short-term bounce or a permanent bounce, stochastic below 20 is always good for bulls in the S&P 500. Go back and do your research. Put this stochastic oscillator on your chart and take a look. If every time stochastic gets below 20, if it doesn't result in a little bit of pop-up, even if it's just short term. So I think there's a pretty good possibility that we could see a bit of a bounce this week, certainly early in the week, and maybe the whole week will be a bit of a bounce. Another thing that's pointing to some potential bullishness is the Bollinger Band. Now, I'm going to get rid of this indicator down here. We don't need it for this particular forecast. But what I want to point out to you is that price action is below this Bollinger Band. We can make an adjustment here. The generalization in the trading world is that it's a 50-period daily moving average on the Bollinger Band. And if price action gets outside the bottom band, it shows that the market is oversold. This is 2 standard deviations. We call that extremely oversold. If it's 1 standard deviation, we call it oversold. And guess what 3 standard deviations is? It's so infrequent that we don't even have a name for it. But check this out. If I bump up our standard deviations to 3, you'll see that on Friday, price action closed beyond the 3 standard deviations in the Bollinger Band. Now, if you're not a nerd, this might not be that impactful to you, other than to say this: price action does not typically stay 3 standard deviations outside the Bollinger Band. It needs to reconcile, and it will probably reconcile up. Go back in time, put a Bollinger Band on your chart. Check this out: 3 standard deviations off, boom, it was the bottom. Now, one thing to point out is this was at the bottom of a bearish move, and we're just actually beginning a bearish move up top here. So that is different, but it's not completely unprecedented. Let's see how far back we have to go. I think you have to go all the way to COVID before we found another 3 standard deviations out from the Bollinger Band. Here's a good example. We were at the top, boom, the market snapped down because it freaked out when everything came to light with the COVID virus, and then we saw the market pop back up. I think this could be where we're at in the current weekly trading. Now, whether we continue on down next week or whether it's the permanent bounce, I don't know. We're going to have to see how the rest of this week shapes up. But I think there's opportunity, and there's definitely signals for the market to find some support. So I'm hopeful on that. Now, for the week ahead, let's take a look at our trades. I said in the introduction, we've got planes, we've got trains, and we got cruise liners. Let's start with our planes trade. We've been trading Southwest Airlines and putting fat stacks of cash in our jeans. Not 1, but 2 market forecasts ago, we did our first trade on this. We made a bunch of money. Then we had a second opportunity to jump in. We made a bunch of money. That was the last market forecast. Now we've got today. I think there's an opportunity, if oil prices stay high, to jump in as Southwest tried to rebound a little bit, but it looks like we could be heading on down lower, certainly if oil prices stay high. The next one, ticker symbol UNP, is Union Pacific. This is an interesting stock to me, and it's contrarian to the rest of the market. The whole market is looking down. I think Union Pacific may have completed its downturn and possibly could trade up. This is a trade I talked about with our power trader students. One of the things I love is the stochastic on this. We're down below 20. But check this out, a little bit of common sense with Union Pacific. This company is who delivers a lot of the oil in North America. So as production ramps up, guess what they're going to be doing? Delivering oil. Also, guess what's one of the most efficient means of transportation when oil prices are high? Trains. Trains go so much further on a gallon of diesel than their truck counterparts. So I think Union Pacific actually could do well if the price of oil stays high. Now, the last one, the cruise liner, this is Carnival Cruise. And I feel about Carnival like I do Southwest Airlines. They failed to hedge their fuel prices. And as fuel prices stay high, I saw reports that this could be costing them $1 billion in profit. Now, that depends on how long fuel prices stay high. But I think there's an opportunity for Carnival to come on down. Now, you see these orange lines again. We took the time to do that super fancy analysis in Power Trader. You get to benefit from our work we did there. But down around $22 and also again around $19.50 is where I think Carnival could find support. So I've got an entry. We entered this. The benefit of coming to Power Trader is you get to see the trade firsthand. We entered this almost perfectly at the top of that wick on Monday morning, and we're expecting it to trade on down. We will get out of this trade just a little bit before it bounces on our confluence line. Come join us this weekend. We're doing a mega class on swing trading with Chris Burgess. It's going to be wonderful. It's totally free. Take a moment and leave a comment below. It really helps the YouTube know that we're providing valuable content. And until I see you again, blessings and favor on your trades.